Good afternoon, ladies and gentlemen, and welcome to the SDI Interim Results Investor Presentations. Apologies for being momentarily late. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in the question in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. They will be made available to you via your Investor Meet company dashboard, and we will send you an email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll and would very much welcome your response to that poll. And I'd now like to hand over to Mike Creedon, CEO, and John Abell, CFO of SDI Group. Good afternoon.
Good afternoon. I'm Mike Creedon, the CEO of the SDI Group. As we are both shareholders and non-shareholders at the meeting, I will do a short introduction about SDI, and any further information, please visit our website or email info@thesdigroup.net. By the way, all emails come directly to me, so hopefully we should get a quick response from me. SDI is name-quoted group specialising in the acquisition and development of companies that design and manufacture digital imaging products and sensing and control products for use in science, technology and medical applications. It was floated in December 2008 as a vehicle to buy and build. It had its problems in the early years, but we've now turned the business around, and from February 2014 we started to acquire businesses. To date, we have acquired 12 businesses using equity, internally generated cash and debt. The game changer for us was in October 2015 when we acquired Centec for £2 million, 4 times profit before tax. We raised £2 million at 8 pence a share, attracting EIS and VCT funds. We are now trading at, I think, about £1 or thereabouts per share. This is a pleasing result for me, as I see an important function of my job is to create shareholder value. So if I just, I'm just trying to go, here we go. I just like to go backtrack, that's it, to there, to slide 3. We will cover the group overview, highlights, acquisitions and Monmouth Scientific, COVID update, financials, a bit on the M&A, and also summary and outlook. The group overview on page 5. We have used this diagram over the years to give a quick overview of the sectors and business units within the sectors. We've added another business unit with our sensors and controls, being Monmouth Scientific, and I'll discuss that when we go through the slide back. But any detail behind the business units within the sectors can be found in the appendices at the back of the presentation. I'd like to hand you over to John now, who will go through his slides.
Thank you, Mike. Yeah, good to be with you all. So this slide is in front of you, should be number 5. It's called Track Record, and it's showing the record of SDI over the last 6 or 7 years. So roughly from the period when SDI started buying other companies, and you can see on the left-hand side, top left, that sales have been going up quite strongly every year, and the H1 of this year is no different. So you can see that's very strong sales in our first half. We'll come onto that further. On the top right, we have adjusted operated profit and also cash generated from operations, and you can see there that our first half of this fiscal year has also been very strong on both of those points. Strong on profit and also extremely strong on cash generated from operations, which is nearly as high in these 6 months as our full year last year. So we've had, over the years, very strong financial growth. This half year, sales grew 23%, and adjusted profit before tax grew 52% on the year ago half year. As Mike said, we're very acquisitive. We've done 12 acquisitions since 2014, and that includes the recent acquisition of Monmouth Scientific on the 3rd of December. Of those acquisitions, 7 of them were new standalone operating units, and 5 have been combined with existing units. And as we've grown our revenues and our profits, we've also grown the skills base of the group, and I think we're a stronger and bigger and better company as well over time. Share price generally follows profit, and it has done. We had a dip during at the beginning of the pandemic this year, and it's taken a while, but now it's increased again, and it's back up to a high point. I'm going to move on to financial highlights of this half year. So revenue increased by 23%. Of that, 7.7% was organic growth, so growth of the revenues of our existing businesses, and about 1.8 million was provided by the Chell Instruments acquisition of November of last year. The big story, I think, of this half year for us has been obviously the consolidation of Chell Instruments, but during the COVID pandemic, most of our businesses were negatively impacted by the pandemic, as was the broader economy. But we've had two business units and lines of product lines in particular that were favorably impacted by COVID-19, in the sense that one of them produces a product that goes into the treating of COVID and another into the testing of it. So the sales from these have quite neatly offset the reduction in sales of the other parts of our business. We'll go into that in a bit more detail in a while. Because revenue overall has stayed more or less at the level we might have expected it to had the pandemic not occurred, but also because we've been able to save on a lot of costs during at least the early part of the first half of this year, our profits have held up very well. In fact, they've increased quite dramatically by roughly 50%, depending on the particular line on the income statement you might want to take. So, as an example, almost the bottom line, adjusted diluted EPS, which is my favorite profit measure, increased by 45% to 2.47 pence for the half year, and that's compared with 1.7 pence last year. In addition to profit, cash generated from operations increased by 130% in the half year, and that benefited also partly because of the increase in profit, but also because we have had customer down payments for some of our shipments, especially the ones in Attic Camera that benefited from the COVID pandemic. So net debt at the end of the 6-month period was 0.3 million. That compares with 4 million at the beginning of the period. Move on to the next slide and give a bit more detail. So we divide our group into two reporting segments: digital imaging and sensors and controls. In digital imaging, sales increased by 23%. Now, there we've had the contract for cameras going into PCR test equipment, which has been very favorable to us. And at the same time, while our Graticules business has suffered like most from the pandemic, Symbiosis within our Synoptics group has done pretty well and has launched its Autocol product, which is, without much marketing, is starting to sell very well. So sales up 23%, profits up 52%, and again, that is due to both the higher sales and cost reductions across the group. Same time, this one-off contract for PCR test equipment, for the cameras going into PCR equipment, has forced us to rapidly increase production, and we have a new site in our Lisbon factory, a new factory there, that with more space, and that was able to ramp up very rapidly to increase production to meet this demand. And not only to meet it, but to do it in a more efficient way. So we've changed the kind of way of producing, and we've been able therefore to scale up without scaling up the same level of cost. All of the other manufacturing sites remained open, but with lower costs during the lockdown. On the sensor control side, sales also increased by 24%. Sensor control includes the Shell Instruments unit, so we've had the contribution of that this year of about 1.8 million in the half year. Apart from that, MPB Industries makes flow meters and was able to supply 40,000 of these into ventilators for use by the National Health Service in the UK. That boosted their sales. Adjusted operating profit increased by 15% to 1.6 million. And again, in MPB, we had to massively increase capacity, and we did so with the help of other members of the consortium, including Ford Motor Company engineers, who came onto our site to teach us how to do mass production. So we're very grateful for that, and it's enabled us to increase capacity, but also to do it efficiently, and that will have benefits going forward. Again, other sites remained open with lower costs, and in that segment, we've placed, after the period end, we've placed the newly acquired Monmouth Scientific. And Mike will talk to us about that acquisition.
Okay. SDI, last week, we acquired on the 3rd of December, Monmouth Scientific. As you've seen in the press, I think it was last Wednesday, Thursday. It's a good acquisition for us. We're going to pay about 5.8 million for the business, and that includes a 2.1 million earnout based on its year-end, 31st of March 2021, adjusted EBIT. The rest of the payment, we've got 2.66 million was paid out, as you've seen from the broker's note, for the initial payment for them based on historical earnings. And that was a 5.5 times multiple. And the balance of 1.1 million will be paid in January for the balance sheet for the net assets we acquire as well. So the balance of 2.1 will be paid at the end of their audited period, which is going to be, I suppose, April, May time. Monmouth Scientific is a manufacturer of biological safety cabinets, fume cupboards, laminar flow cabinets, and clean rooms. This is a sort of a very big market currently, especially the biological safety cabinets, as its strong growth within the COVID-19 era, whereby they're using PCR machines within the biological safety cabinets. It's based in Bridgewater in Somerset. Its end markets are quite wide. Currently, they've got laboratories, pharmaceutical companies, electronics, medical, and education. This acquisition is in line with the group's strategy of acquiring businesses with complementary products. Another area which is worth pointing out is that the founder, David Pomeroy, who set the business up 17 years ago, will still continue to lead this business. He's built up over the 17 years. And if we move on to the next page, which is page 10, I'm going to quickly discuss about COVID-19. This is quite a detailed self-explanatory slide. I'm sure the slides will be available for you after this meeting. But I'll just highlight a few points within COVID. All our business units have remained open throughout the period, with a number of our staff, especially the sales and admin staff, working from home. We furloughed about 17% of our staff, but is pleased to note that all our staff are back in full-time employment. I'm afraid to say that there are a number of roles within the group that have become redundant. But this is no surprise, as a number of companies have had to take this type of action. This pandemic has generated a high demand for products within two of our businesses. One is MPB Industries and the other is Attic Cameras, as John's discussed, and also it's actually discussed in the annual report. But I would like to sort of repeat what John has said. We do not expect these contracts to continue beyond the current financial year ending 30th of April 2021. And that's to conclude is that we've reduced our cost base in a number of business areas through the pandemic. But what we've found is we've gained efficiencies and also giving improved capacity and output through this. So I think it was a good exercise in looking at the cost bases. And what's pleasing across all the business units is we've got some very, very good senior managers and directors within there, and they took appropriate action themselves without any input from myself and John. From that, I'd like to take you back to John, who will now go through the financial pages.
Yeah, thanks, Mike. So I'm looking now at the income statement. I'm not going to take you through every line of this, just to say that revenue is up 23%, as we've already said. Gross profit is up 21%. So there's been a slight reduction in gross margin, and that's due to just mix of products, and in particular the attic cameras sold into the PCR machines come in at a slightly lower margin than the rest of our business. At the same time, they have a very low cost base underneath that, so costs overall profit has benefited from that. As you've seen, all of these various lines of profit, operating profit through to diluted EPS, they're all up roughly 45 to 58%. So very good improvement on previous years. Onto the balance sheet. Again, I'm not going to take you through this number by number, but if you look on the right-hand side, you can see movement in cash. We started the half year, or the end of last year, we had a net debt of £4 million, but that was made up of 5.3 million of cash and 9.3 million of loans. We've generated a lot of cash in the period and reduced the net debt to 0.3 million, paying off the revolving loan. So we ended the period with 3.4 million of cash, and our amortizing loan, which will be amortized through to 2023, of 3.8 million. That leaves us then with £5 million of unused bank facility and 3.4 million of cash, so plenty of firepower available for acquisition. Bearing in mind also that our businesses remain cash generating. So in December, we used 2.4 million of that cash for the first payment for Monmouth, and we expect to pay a further 3.2 million of cash over the course of January through to April or May of next year, for the balance of that acquisition. On this next slide, there's a bridge showing more or less the same thing. We start the period with 4 million of net debt, strong operating cash inflow, and also favorable movement of working capital because of the customer down payments received for cameras, and then finishing with a net debt in October of 0.3 million. And then on the right-hand side, I've added in pro forma the total outlays for the Monmouth acquisition of 5.6 million. So our pro forma net debt post the acquisition would be 5.9 million, but of course we're going to generate cash in the meantime. A further slide here on cash flow, but I'm not going to go through that. Just again to say that cash flow overall has been very strong. Cash generated from operations plus 130%. Based on strong profits and the benefit of customer down payment. Now a slide on M&A. I think Mike will take this one.
The presentations, we've discussed our acquisition criteria in some sort of depth. Also, I could like to put you through to the annual report. I think it's on page 14. It does give a detailed page of what we expect as we go through the acquisitions. This time, I'm just going to highlight a few bullet points. And here we go. So through the pandemic, we've seen reduced levels of activity, but mainly due to lockdowns, whereby we've been able to have face-to-face meetings and also site visits. But thankfully, we did manage to continue our M&A strategy with the acquisition of Monmouth Scientific in this period. There was a question which I'm going to answer, which is about valuations. Valuations have always been based on historical earnings, usually an average of a 3-year average and a multiple of between 4 and 6. but I think we're seeing more deals using earnouts within the valuation. I'm comfortable with short-term earnouts, a matter of months, probably even up to a year, but no longer. The reason for that is that it's difficult to actually ring-fence the profitability using our strategy of investing for growth. So what we don't want to do is to buy a business, invest in that business, and after 2 or 3 years, we're still rewarding the sellers for our hard work on the investment. And the last bullet point, I'm sure you're aware in the press, is in the short term, it will be interesting to see the impact of the proposed changes in capital gains tax, which are being discussed by Rishi Sunak in Parliament, as this may impact future acquisitions. Because what he's trying to do, or he's thinking of doing, is align capital gains tax with income tax. It will have no impact on us, but it will have on our sellers going forward. Then I think that's it. And then let's just go through to the summary and outlook. Half year, as John's rightly said, we've had a fantastic 6 months with record revenues, profits and cash flows. Sales haven't really had a negative impact regarding the COVID pandemic. And we've had 2 businesses which have actually suffered, and that was Applied Thermal Control and Shell Instruments. But the good thing about our businesses, all businesses, units, have been profitable and cash generative throughout this period. And my job is actually to support these units when times are hard. Then the final point on our half year, it was just after half year, on the 30th of December, we continued our buy and build strategy and acquired Monmouth. Outlook going forward, the board is still confident to meet the expectations in the market, and we're looking for normalisation in the following year in 2021-22, which means hopefully our recovery of all our businesses which have been negatively impacted. We're actually seeing signs of a turnaround within our businesses now. And the last point is that we continue to look for further acquisitions which fit our criteria. So when we grow the business, what we're looking for is both organic growth and through M&A. So I think that's it. Thank you.
That's brilliant. Thank you very much indeed to Mike and to John. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while we give the company a few moments to review the questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation, as usual, you'll be redirected for the opportunity to provide your feedback in order that the company can understand your views and expectations. We would very much encourage you to do so. It is very useful for the company to receive that. Mike, John, obviously investors had the ability to pre-submit questions. We received a few. Perhaps what I'd like to do is start off with those ahead of perhaps asking you to look at the questions that have come in. But the first question that we received was with regards to areas of your business that has been benefited from COVID or one-off contracts won, which were mentioned in your interims. How is SDI trying to maximise these going forward, i.e. investment in those areas, or prepare for potential further contracts in the future or a third wave?
Yeah, I'll answer that. It's Mike. As John's rightly pointed out, we had 2 big contracts which made the press, which is MPB ventilators and PCR machines with Attic. Going forward, we can actually see that Monmouth is actually selling its biological safety cameras cabinets for helping with PCR. But across all our range of business units, we actually don't know what the end goal is. We sell to labs, pharma companies, medical, and other sectors. But really, we don't know specifically where our equipment's going to and if it's COVID related. I'm sure it has to be, but we don't really know, I'm afraid.
Okay, thank you. Then there was a follow-on question from the same investor. How closely do you monitor others within your businesses on their direction of future acquisitions?
We do, just like we actually monitor our customers and our competitors and suppliers. We don't look too heavily at them. We're doing, I think, a reasonable job on gaining organic growth and mergers and acquisitions. And it's always nice to see what other people are doing, Halma and Judges. But we continue with our own work and try to get the best shareholder value for our investors.
Thank you very much indeed, Mike. Couple of questions combined here, but what percentage of product demand is for health, what percentage of the above for COVID vaccine delivery? And thirdly, what percentage of the above is for COVID testing?
Yeah, John here. So it's difficult to define exactly where research ends and health begins. So I don't think we can really give a number there, but we certainly have quite substantial health-related sales or medical-related sales in Synoptics and in Attic and in Centec and in MPB and certainly also in the new Monmouth Scientific acquisition. So there's plenty of, it is a large part, and in fact, up until recently, the stock market used to classify us as being medical related. They've now stopped that, but medical and health still is a substantial part of what we do. Now, specifically on vaccine delivery, we're not really involved in that, although obviously the research into vaccines involves PCR testing, and to which we contribute, both in terms of cameras going into PCR machines and the Monmouth Scientific biological containment cabinets that house these PCR machines. So not really on vaccine delivery, but certainly on the testing that vaccines have to go through. On COVID testing more generally, well, specifically, we do sell into PCR instruments. And so PCR instruments are used for testing. We probably have sales in excess of £5 million in Attic into PCR instruments this year. And then probably our new Monmouth unit will also sell roughly £5 million worth of sales into cabinets that will contain PCR machines, although we can't really be sure how many of those are actually housing PCR machines. So roughly speaking, I think you can say that of this year's total year's sales, but including a full year from Monmouth rather than just the half year, probably in the order of magnitude of about £10 million are going into to COVID testing. Although obviously, these machines are going to be used not just for COVID testing, but for other things afterwards as well.
Thank you very, very much indeed, John. There is just one final question that reads, please would you advise how much furlough money you received in total? And given the excellent half-one results and the fact that some parts of SDI benefited greatly from COVID, have you given consideration to returning these funds to HMG?
Yeah, so we did receive about £125,000 of furlough subsidy. We put about 17% of our workforce on furlough during the initial phase of the pandemic. And we have to remember that then it was a highly uncertain situation, and our alternatives aside from furlough were either to let people go or in some cases to have them do useful work, but at some risk to themselves and to the community. So we opted to take the furlough and made an active decision to use the furlough on offer. And we think we did this for good reason and the right reasons at those businesses that were really suffering. So I think we did the right thing and it had the desired result. So I think we're happy about that. We then brought them all back in the early summer, so we're no longer using furlough.
That's brilliant. Thank you very much. Thank you very much, John. Well, that takes care of the pre-submitted questions. If I could ask you both very kindly to click on the Q&A tab. If you would start at the top, perhaps if you could read out the question, who it's from, and give a response where it's appropriate. Obviously, there's quite a considerable amount there to go through. I think some of perhaps the same content, so I guess some questions may be answered through others. But if I could hand back to you, Mike and John, and if you could start at the top, read the question and who it's from, and then give your response, and then I'll pick up from you afterwards. Thank you.
Okay, should we start at number one? For M&A, has COVID had any effect on potential vendors' valuation expectations? Yes, it has. What we've actually found with a number of these companies, 2 or 3 of them have actually fallen away because COVID has hit their profitability. So with our multiples of 4 to 6, they're not going to get the valuation they actually expected. So what we actually do is we don't discount them. we discount them short term, but hopefully they're going to come back in 1 to 2 years' time to come back, and we can acquire those businesses. So I think that answers the question.
Okay, and John again. So the next question is from John H, and he's asked, what do you see as the opportunity for Attic in the medical space post-COVID? Do you want to take that, Mike?
Yeah, hold on. Yes, I will do. To tell you the truth, a lot of our business, a lot of Attic's business is in the life science business, and it's OEMs. Now, this is a long lead time to get these products into the marketplace. We are looking at it. We're looking at to see whether there's any other business selling our cameras into the PCR market. But we've got a good sales marketing director within Attic Cameras, and that's what he's actually pursuing. So I don't know at the moment, but I'm sure there will be opportunities. I don't think you were saying post-COVID. Post-COVID is not going to go away in the next sort of six months. It's going to be, I think, long term, really.
Okay, and the next question is from Martin S.
Yeah, I think that's from me.
Yeah, I'll just read it out, Mike, so that you can all hear it. Given Monmouth is a predominantly UK-centric focused business, could you expand on the opportunity that may exist in the US for it to expand via existing businesses within the group?
That's one of the reasons he wanted to sell and we wanted to buy, because 80% of his business is in the UK. He's got 20% scattered around the world, but nothing into the US. So we've actually got a very nice, small, neat sales and marketing office based in Frederick, in Washington, DC. We've got about 5 staff over there, but we use manufacturers reps. These are not just one person on a commission only. They're actually groups of people. So we've got 2 very strong ones, one in Boston, looking after the universities and the research labs, and another one who does directly with the NIH. And as soon as planes are running, then he's hoping to get over there and we can make some sort of introduction for him into that sort of market.
Okay, and next question, Mike, is from Patrick L. Mike, you stated that Monmouth Scientific was purchased on a 5.5 times multiple. Can you clarify which metric or time period was used, as due to the pandemic, earnings appear quite volatile?
Yeah, sure. So what we actually did is the initial payment of 2.66 million was a 2-year historical. So that was years 19 and 20. So that come out about 484,000 on a 2-year average, if you work the maths out at 5.5 times. He's looking to do 1.5 to 1.6 million. So what would actually happen is that pot of profitability will be added into the other 2 years, divided by 3, multiplied by 5.5, and that will give the valuation of the business. And we just pay the difference between what we paid last week and what we're going to pay in, I don't know, April, May time. And that's how we actually work that out. And if you look at it, it is a bumpy year at 1.5, 1.6 million. But you have to look at the 3-year historic, which comes out to be about 800,000. And by the looks of it, his order book and what he wants to do with that business, I'm sure this is a very good acquisition for us at 5.5 times. That if he can actually do 800 to 1 million every year, it's a good buy for us. And he does want to expand it, and we want to help him do that. So I hope that answers your question, Patrick.
Yeah. Next question is for me. I think it's from Bruce A, and he asks, is any of the strong improvement in cash flow due to one-off actions that are likely to unwind in H2? And yeah, and I should have mentioned this earlier, in fact. So yes, we did benefit in the first half from customer down payments for the Attic cameras deliveries into PCR machines, and that will unwind in the second half of the year. So definitely we shouldn't expect the same level of cash flow, and in fact that should be a net negative for us in the second half of the year. So of course we do intend to be cash generative in the second half of the year, but it won't be at the same rate as in the first half, because those down payments will unwind and we'll get back at the end of the year, we expect, to more normal levels of working capital. I hope that answers that. Next question is from Bhaskar P, but I think Mike's just answered that. So roughly the same question as Patrick's earlier. So I think we can skip over that one. Julian G, on the other hand, asks, thanks for the presentation. What are your long-run targets for return on capital employed, EBIT margin, and free cash flow margin? Well, that's a kind of difficult question. These have been improving over time, and I think as we go forward, we're expecting that acquisitions are accretive to, in the long run, to these measures. But we don't really put a target on it, but we're expecting the ongoing business to improve, and then we'll add in new businesses that themselves can improve and kind of join the long run average or even improve it, because head office gets always to be a smaller percentage of the total than in previous years. So no hard targets, but onwards and upwards. Next question, David B. Do you believe your existing businesses have pricing power? And is this something you look for in acquisition? Do you want to answer that, Mike, or shall I?
Yeah, no, I don't mind. It's fine. We don't actually look at pricing power at all within the businesses. We do look for organic growth. The problem is all our businesses are actually quite small businesses. We deal with big customers. So what they're actually looking for is a sort of value for money, especially within the OEMs, and also quality. And so we're never driven. We have, as you can actually see within our annual reports, we do have good, very healthy gross margins. We do try to expand on those margins, but what we have to do is to make sure that it's a juggling act between increasing prices and demand. And so what we don't want to do is actually to lose business through overpricing, really.
Okay, next question, quite complex. Alexandra, could you please help us better understand the economics of Monmouth Scientific, structural margins and return on capital employed? First sight, it seems less technically complex than some of your other businesses. Can you therefore get similar economics? I think this is kind of following on from that previous answer, really. So is a biological containment cabinet any less complex than some of our other products like cameras or chemical sensors or flow meters? And I think the answer is that if you do it properly, it is as complex, and we can get similar kinds of economics. Obviously, we're talking here, we're buying wood and plastic, so there's a lot of that going into one of these cabinets. But in the end, if you're making the best cabinets, then you can get pricing power for those, and the economics can be similar to the other parts of our business. So I think we're very confident that this is a business that can increase its profitability and at the same time grow. Another question now from Bhaskar again. No deal Brexit, impacts aside from FX, any tariffs, what are the main risks?
Do you want me to answer that? Yeah, that's fine. Yeah, we've looked at it. Our non-execs, especially David Tilson, raises it at the board meeting every month, and rightly so. What we've had a look at is I don't think it's going to make that much of an impact on our group when we actually speak to all the subsidiary directors. I think the major impact for us really is the amount of paperwork involved. I think people are worried about shipping into Europe, but we do ship all over the world. So what we're actually doing is using a similar sort of type of paperwork to actually ship into Europe. Regarding tariffs, I think there's only one area which is hit by tariffs, and that is the sort of antifreeze type of liquid we actually put into the chiller units, which is sort of a reasonable sort of tariff. All the rest are zero or quite low. And also back to that antifreeze, it's quite low revenue stream for us. It's very small. So to us, I don't think it's a big impact.
Thanks. Another question from David B. Roughly, what is the revenue mix between one-off capital equipment and repeat sales and services? This is really difficult because we have to look across, all 9 businesses. I think the mix is towards capital equipment, but probably towards capital equipment or components for other people's even larger capital equipment. We do have plenty of repeat sales and services, so some of our businesses are entirely devoted really to repeat sales and services or disposable units that need to be replaced. So there's plenty of that, but I think overall probably it's slightly more towards capital equipment, although not necessarily the biggest part of that. But in the end, we depend on customers selling their equipment for us to be able to sell ours to them.
If you want to have a stab at roughly what the recurring revenue stream, it's about 15% of turnover. So the main areas really are Astles, Centec and Shell, and a few other small sort of recurring revenue streams across the group. But it's roughly about that sort of figure, but it does change.
Good night. Gavin W. asks, how far has trading returned to normal across the group businesses?
Do you want to say that, John, or I will do it? Doesn't matter.
Yeah, I can do that. So very much so. I think we've seen since the summer, people coming back from summer, those that were able to get away, we've seen that businesses has picked up across all of our units, and in some cases it's, you know, we have units which are quite lumpy sales, but some of them are seeing now record months of sales. So I wouldn't say we're quite back up to pre-COVID levels or indeed budget levels across the group, but we're certainly getting there, and they're much higher than they were at the beginning of the period. So I think we're talking about less than 10% gap now between where we might have hoped to be without COVID and where we are in most of our businesses. And the exception to that remains Atik Cameras, which is trading far ahead of where it would have been without COVID. Another question from David B. What's the mix between industrial and academic customers? And here, really, academical is certainly part of what we do, but it's not a huge part. So we're selling much more to industrial customers, but also to hospitals and others that aren't really academic, although they may be public sector. So I think academic is important to us, certainly in one or two of our units, but it's not the biggest part of the business by any means.
Also, I think it's a very grey area between industrial and academic. It's just not black and white, really. I think it's difficult, and we don't actually analyse it into that much detail either ourselves.
I have another question here from Jeremy P. I've been a shareholder for some while. The group still feels like a fragmented collection of some very small businesses with limited links between them. Does your acquisition strategy focus on reinforcing the successful businesses that you have? Mike, you can take that one.
Yeah, can you wind it back to the diagram of the businesses? Yeah, it'd be easier to explain it in that. I think we discussed this quite a few occasions in the city, that one there. So what we've actually done over the years, since February 2014, is acquire 12 businesses. And what you can actually see there is we've got 9 business units. Some of the businesses we acquire actually slot nicely into other businesses. A good example is Atik Cameras. It's selling cameras to the astronomy market and also to life science. It was selling into Synoptics as well, so it's cross-selling. But what it wanted to do was go up the value chain, so we acquired QSI. And prior to that, we acquired Opus Instruments. All that's done in-house in our factories in Lisbon. Synoptics, again, we acquired a small business of FireStream based in Loughborough, and we integrated that into Synoptics. Sorry. Going further down, we acquired Applied Thermal Control based in Colville, a chiller business for the life science. And then we had an opportunity to acquire another chiller business, but the industrial sector. So the sales databases didn't cross over, and that was based in Leicester. So what we've actually done is combine those 2 units in a unit in the Barrow upon Sur, and we've reassigned the leases of Colville and Leicester. So what we're actually doing here is actually just expand it. First of all, we've got 2 different business sectors. So we're either having the businesses as standalone businesses, or we're actually integrating into other businesses. But if you have a look, backtrack at Halma of what they actually did in the 1980s, it's a very similar sort of type of way of M&A. So as you acquire them, you put them into the pots, and there is cross-selling between them. as I mentioned to you before, with Monmouth. We've acquired Monmouth. They're very keen on moving into the States and also using our distributor base in Synoptics. So the sales and marketing manager, as soon as we acquired, wanted to be in touch with Applied Thermal Control and Synoptics because he thinks we cross over on our customer base. So I think you're being a bit harsh, really, on saying it's very fragmented. But we do come across this quite often.
I think I would add here that if we had an acquisition strategy whose focus was on reinforcing our existing businesses, it would be a very nice strategy, but we may end up not buying anything. So we have to buy what's for sale, and we make sure it does fit our criteria. So we have a group of 9 businesses which have a lot in common, but we can't just focus on building them out because we probably have some of the premium businesses in their industry in the UK already, and it's hard then to find others to add on to.
And also, as John has said in the financial statements, we sell over many different sectors. We wouldn't have the results we had if we just focused on one sector. So there are some ups and downs in the group, but overall, the market, we produce some very good profitable figures, and hopefully to grow on that by acquiring more businesses on organic growth and cross-selling between the business units.
Okay, next question from David L. Were the Monmouth acquisition discussions initiated and underway before the pandemic, or did it come after it hit? After it hit.
So where Ken Ford and I had initial meetings in Taunton, in the Holiday Inn in Taunton, with David Pomeroy, and from then on, we started talking, having more meetings, and then I was down there doing due diligence. And again, at completion, I sat with David last Wednesday night to complete the accounts, and then I'm back down there next week. So it was right the way through the pandemic, and it was a successful acquisition, hopefully, anyway. Well, I'm sure it will be.
Yeah, another question here from Leonard K. Is it possible to tell investors what market expectations are? Without that, this phrase is largely meaningless. And I do have sympathy with that. I think you're right. How we judge market expectations today is that there's only really one analyst who follows SDI, and that is the house analyst of FinCap, our broker, and we take his forecast to be in line with the market expectation because we think the market takes its lead from his reports. And they are available for download. I think you have to register to get them, but they are available. So that's what we understand today to be market expectations. But I certainly take your point, and I think we could, going forward, say we expect profit to be in line with market expectations, which are X. And I think that would probably be a useful thing to do. I'm not going to do it here and now, but I do think we should look at that going forward. So good question. Next question is from Gerard. You've previously stated that you aimed for organic growth of 8% and acquisition growth of 20%. Is this still your aim? Mike?
I think, sorry, yes, I'm on. Yes, I think it still is. I think it's very, we still want to, we always have targets. We've always said to the city that we'd like organic growth in the high single digit figures. Acquisition growth, yes, 20% is achievable, but we're not going to rush into buying businesses just for the sake of keeping the city happy. So we have to make sure all our acquisitions tick the right boxes and adhere to our acquisition criteria. So I think acquisition growth is a difficult call, to tell you the truth, but it's a target we like to set ourselves anyway.
Thank you. Next question from Mary E. Are you expecting any impact from a no-deal Brexit?
I think we've already answered that.
Yeah. And Bhaskar again. M&A deal sizes, is there a max size you're comfortable with?
No. I think the problem is we've discussed this on a lot of presentations over the last few days, is our sort of niche zone is between sort of 500,000 and 1 million profitability. Anything greater than that then you're actually competing with the likes of private equity, maybe even Judges, Halma, etc. And also the multiples grow. We're buying businesses between 4 and 6 times. You're going to get into 7, 8, 9 times multiples to higher, and also you're getting into a bidding war. We've got another one after with him as well.
Yeah, I want to take the next one, which is about how much competition there is typically in an M&A deal. 1 or 2 or maybe 5 plus competing competing price.
He hasn't put 0 in there. It's 0 in, I think it was 12 of our deals. It was only one bidding process we had, and that was in Shell in November of last year, when there were 12 people bidding for that. There was 7 private equity, and then there was 3 trade, and we came out, and we weren't the highest bidder by the way. We completed that deal to the beginning of December of last year.
Yeah, thanks. So next question, David L. Could you quantify the approximate magnitude of the contribution from the one-off contracts in 2021? Yes, I suppose we can. I think in the first half of the year, those 2 contracts probably generated around £3 million of revenue in excess of the same revenue to the same customers for the same products of last year. So about £3 million of additional contribution. For the full year, I think if you want to guess, I would say it's probably slightly less than that for the full year, but that's still to play for. Next question from Lucia. Last time, I believe you mentioned that there will be more management personnel and engineers on identifying future acquisition opportunities. What is the current situation? And are the acquisition criteria changed, or do they remain the same?
Okay, I'll answer that. Yes, our in-house management do help with the acquisitions. If you look at the one we've just completed last week, Monmouth Scientific, we've got some very competent engineers. One of those is Peter Astles, who founded Astles Control Systems. He came out and sort of ticked the boxes with me. So we can use in-house engineers and expertise to actually look at the technical side. Because at the end of the day, myself, Ken Ford, and John are financial people, so we do need help, and we can drag it from our own senior management team. And backtracking in Shell Instruments, Peter came out and had a look at that. But also, so did Steve Chambers. Both of them are very competent engineers and give a good view of the business. So yes, we do. And has the criteria changed? No, it still remains the same. So if you look at our annual accounts, I think it's page 14. He gives a list, and that's the list we adhere to.
Yeah, thanks, Mike. Next question from James K. How do you see your cost base going forward? Will some proportion of the cost savings early in the year be maintained, or will it drift back towards previous levels? So I think the answer is that some of it will be maintained. Obviously, we don't get the furlough subsidy, and people are all back to work at 100% salaries. So most of it is now back to a more normal level of cost. But there are still savings from efficiency, and I don't like the word will it drift back towards previous levels, but what we can do is plan to put back some of those savings into specific kind of growth investment ideas. So I don't think we're going to let it drift back to the same level as it was before, but we can reinvest some of those savings to get future growth. So, I think there's a net positive out of all of this. I'm not saying we're going to end up with a lower cost base, but hopefully we're going to end up with a cost base which is more orientated towards growth than when we went into the recession. David B is now asking, do any business units have very concentrated customer or supplier bases?
I can answer that if you like. Yes, a couple of our businesses have 2 or 3 customers, which are a significant part of their business. when we acquire those businesses, you always get a bit worried that they're going to fall away, but they haven't. They're very dedicated, mainly because they're OEM customers. So as long as you can actually provide a good quality product at a good price, then they will continue with us. Supply bases, no, we haven't got any supply bases that are concentrated, and we're relying on one supplier.
Right. Julian O asks, can you give some indication of the scale of the operating efficiencies and cost reductions you've realized this year? Well, in the first half of the year, we've had wage and salary cost reductions of the order of 13% against budget, and other fixed costs or overheads have been much higher than that. In fact, about 26% compared to budget, lower for the first 6 months. Now, the run rate towards the end of the period was obviously a lot less than that. So going into the second half of the year, we're not getting that same level of operating efficiencies or cost reductions, but we're still saving on both wages and on other operating costs. Although we've also got the effect of some costs which were deferred from the first half are coming to the second half. So that's the level we had in the first half, nothing like that in the second half, but still some level of cost reduction. Matthew G now asked, can you quantify the revenue impact in the businesses which were impacted by COVID? Well, I think we've probably mentioned that. So, if you want rough numbers, we've had about £3 million of positive impact on 2 of our businesses, and roughly the same, maybe slightly more of a reduction in the rest of our business in the first half. So overall, there's a net negative on revenues, but a very substantial net positive on the bottom line from the pandemic. Next question is from Emmanuel. Are there any M&A opportunities outside of the UK in the pipeline, Mike?
Yes, we have. We've got one in the US. We did have one in France, but they actually sold internally because we just couldn't get over there to due diligence. So it's very difficult to do anything with these while we're actually still remaining in the UK and can't travel. So we do have a pipeline with, like I said, US companies, but there's nothing we can do at the moment. And they're aware of that as well.
Yeah. And then there's a follow-up question, really. Yeah. So do most deals come from you looking for targets or from targets that are for sale?
A mixture of both. So what we've actually got, what we use, the tools to acquire businesses, is we've got a very good M&A consultant who's on a commission only, and then we've actually brought businesses in via our own businesses, whereby, let's say we've acquired Monmouth Scientific. One of the first questions I have to ask him after we've acquired it is, who should we acquire next? And it's worked very well across the group. And another area is we're getting some interest is through private equity. People from private equity who the business is not for them. I've built some very good relationships, and they hand it on to me as well. So there are a number of routes for these acquisitions.
And I think this is our final question, Mike. So again, from Bhaskar, how many M&A deals have you been outbid or have you lost in this year?
Well, as we've only been through a bidding process for one, Shell, and we've won it, so the answer is 0 on that. Lost on this year, none really. What we actually do is we're a very fair acquirer, so we'll put out a valuation for that acquirer, but we're not like a lot of the big companies or US and chip away at it after due diligence. So we would walk away. Historically, I have walked away from, we have as a company walked away from the deals, but not this year.
John, as you quite rightly said, thank you. I'm sorry to jump in, but every time you seem to answer a question, more came. So I think it's probably an appropriate time for me just to step in and on the hour, just gone through it. Perhaps I could just ask you to wrap up, seeing as you've taken every question that's come in, after which I'd like to redirect investors so they can provide you some feedback. So perhaps if I can hand back.
Very good. Mike, do you want to wrap up?
Yeah. I'd like to sort of say thank you for coming along. I think it was 80% of the people here who are attending today are shareholders. Like I said, my job is to create a sort of shareholder value, and hope John and I have actually done that for you. We started out with a market cap of 3 million. I did have a target. Ken Ford and I had a target to get it to 100 million, and just before Christmas we did achieve that. So we need to set ourselves another target. So I hope we've done proud for you.
That's perfect. Thank you very much indeed to Mike and to John. Ladies and gentlemen, if I could ask you please not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this presentation from our platform, the feedback page will appear. If you access this via the link sent you by email, you'll simply be asked to log in to provide feedback. And I'd very much encourage you to do so. It is very, very useful for the company to hear from its shareholders and also from potential shareholders. So on behalf of SDI Group PLC, we'd like to thank you very much indeed for attending today's presentation. That concludes today's session. Good afternoon to you all, and a pleasant weekend. Thank you.